Let's kick this video off with some stock market predictions. First up, we've got Sean Williams from The Motley Fool, who predicts that we're at least going to see a 20% decline. After that, we've got longtime stock market bear Harry Dent, who thinks that we're going to see a decline of more than 40%. And finally, we've got Jeremy Grantham, a famous long-term hedge fund investor who's doubling down on his belief that the stock market bubble will pop. But here's the thing, all three of these stock market bears made these predictions at the beginning of 2021. So let's really quick revisit how much the stock market went up in 2021 after their predictions. First off, let's talk about Sean Williams with The Motley Fool. He made his claim on April 10th of 2021, and from that point until the end of the year, the S&P 500 went up 15.44%. Harry Dent's claim that you'd see a 40% drop in April alone came out on February 8th of 2021. He made you miss out on a 21.72% gain in the S&P 500 from the day that video came out until the end of the year. And my personal favorite, Jeremy Grantham, who came out and doubled down on his market bubble call on January 7th of 2021. Had you listened to him, you would have missed out on nearly the entire gain of the year, more than 25.3%. And just so you know, I'm not making any of this up. I've left links in my show notes where you can reference the materials yourself and see what these predictions were. One of my biggest pet peeves about CNBC, YouTube, and anywhere else where you've got people making stock market predictions is that the bulls always get called out. Everyone goes after bulls who made a prediction, failed, and had it go the opposite direction. But the bears get away with making terrible predictions too. And to make matters worse, no one calls out these bears when they make bad predictions. To me, it's just as bad to have someone scare you out of a huge gain as it is to have someone convince you to invest when you shouldn't. Extreme bear market predictions really get you a lot of airtime, so a lot of analysts will make these predictions just so that they get on CNBC or one of these YouTube channels. But the problem is it can scare people out of the markets when it's unnecessary for them to do so. An old stock market adage is that these guys predict 20 of the past 2 recessions. In other words, they're just going to come out year after year with these negative predictions and you don't know whether or not they're right. Well, I can tell you in my 25 years of investing in the stock market that I only know one thing, and that's nobody knows which way the stock market's going to go. Sure, some people are right once in a while, but you can't find anyone who is consistently right. Everybody's wrong. But let's forget all that. Let's assume that some of them are right, and I've heard some really wild predictions with the S&P 500 selling off as much as 90% from its all-time high. In this video, I'm going to use the charts. We'll go over what each one of these crashes might look like, and then I'll give you an idea of what I'm going to do in order to prepare for a market crash and how I handle these epic crashes, as I've seen many of them in the 25 years I've been doing this. For the purposes of this video, we're going to be looking at the S&P 500, and the reason why you look at the S&P and not the Dow Jones is that the Dow Jones Index is calculated using price averaging, whereas the S&P 500 is actually calculated using market cap. This is why you see newspapers like USA Today or your average news station always use the Dow, because it's a bigger number, it sounds more exciting, but it's not actually an accurate representation of the market. It's only 30 stocks, and it's averaged their prices together. On the flip side, the S&P 500 is 500 stocks, and instead of just taking their prices, it also takes into consideration how big that company is. And for market professionals, they use the S&P. They don't use the NASDAQ, and they don't use the Dow Jones because they're not accurate representations of the entire market. First off, we're going to take a look at where the stock market is so far in the year. You can see that we have a 2022 low of a 14.6% sell-off. For anyone who's new to the market, it can feel really painful to have a 14.6% sell-off. However, it's actually perfectly normal for a market correction to sell off as much as 20%. It's not until you cross through that 20%, becoming what's called a bear market, before you have to get really concerned about how much further down it can go. So we're going to zoom out a little bit to see what our next stopping place would be, and it would be a 20% sell-off, and this would take us back to the levels that we haven't seen since March of 2021. And as I said, a 20% sell-off isn't actually something to be that shocked about. It happens on a regular basis. But let's say say we saw more than a 20% sell-off. Let's move on and see what a 30% sell-off would look like. A 30% sell-off would take us back to November of 2020, where you can see about where the levels were back then. Next up, we have a 35.4% sell-off. Now, why did I pick that number? Well, it's because it's the exact same sell-off that we saw in March 2020 when we sold off from the high to the pandemic bottom. And this sell-off would take us back to July of 2020 in terms of the levels of where we would be at that time. After that, we've got a 40% sell-off, and this would take us back to May of 2020. And even if we saw a 50% sell-off, that would only take us back to where we were in March of 2020. So we're talking about losing about 2 years of progress. In fact, in order to get back to the bottom of the pandemic from our high in 2022, we'd have to see a sell-off of 54.51%. And just to give you an idea of exactly how extreme that kind of a sell-off would be, it would be the equivalent of almost as bad as what we saw during the Great Recession. During that financial crisis, the market sold off 57.69% from its high to its low. And that was exceptionally rare, not a normal occurrence. In fact, for us to see a sell-off as much of 90% would be not just rare, but historic. An 85% sell-off has only been seen once in the history of the stock market, and that was in 1929 during the crash right before the Great Depression. If we saw that kind of sell-off now, it would take us all the way back to March of 2009. But in order to see a low of that magnitude, you're talking about something that has never happened more than once in the history of the entire stock market. And this was before the advent of all the protections that went into place to protect against that very occurrence since that time. A sell-off of that magnitude would take us all the way back to levels we haven't seen since March of 1995. Now, this isn't to say it's not possible that a sell-off of this magnitude could happen. I'm just trying to illustrate exactly how extreme that kind of a call is. And in all likelihood, if we saw a 90% sell-off in the stock market, there's something happening in the world that's so bad you're likely not going to be worried about where your retirement accounts are. You're probably going to be worried where your bomb shelter is. So what do I do when there is a historic market sell-off? How do I handle that as a long-term investor? The strategies I discussed in this video are just the ones that I use, and they might work for you, but you need to discuss that with a certified financial planner. I am not one of those, so I can't help you with your own investing. You have to make these decisions on your own. My first key strategy is I don't try to time the markets. It can be very tempting, particularly for new investors or for people who don't pay attention, to suddenly see that their portfolio is down a lot. They might want to sell their entire portfolio and try to get in at a lower level. But here's the problem. No one knows where the bottom is. So if you sell when we're down 13% and then it turns out the bottom was 16%, the chances are the S&P 500 will bounce hard off of that 16% bottom. If the S&P bounces above where you sold off before you get back in, then you will be down even more than that loss because you took the loss and then you waited until it bounced above your position before you got back in. In other words, if you time it wrong, you would have been better served just doing nothing at all and holding on to your investment through the sell-off than you would if you tried to time getting out and getting back in. I know people who during the pandemic sell-off closed all their positions down 30% because there were pundits out there who said we'd see a 50% sell-off. The pandemic bottom was at 35.4% down, and when the S&P bounced, it bounced really hard. To make matters worse, this made people think that the S&P would retest its lows, so a lot of the people who sold down 30% waited because they thought the market would go back down and test that bottom, which it never did. So if you sold down 30% and waited until the S&P was down 20% to get back in, you just took a 10% bigger loss than you needed to and 10% more than if you just held on to your position. For me, I have certain rules that I follow when it comes to selling positions or taking profits in positions. For instance, they have to exceed the target allocation for my portfolio size. Additionally, I only sell on green days and I only buy on red days. In other words, I only sell into strength and I only buy on weakness. This prevents me from doing what the rest of the herd is doing. I never panic sell and I never panic buy, which is something people don't talk about very much. Panic buying is where you see your asset or the stock market going up and you've got such a fear of missing out or FOMO that you buy up. as it goes up, where in reality, if you just waited a little longer, it would probably pull back to a lower level than where you get in. Second, I always use a limit order when it comes to anything that I'm buying. When a stock or the S&P or an ETF sells off, by using a limit order, you're guaranteeing that you're going to get the price you want or better. You're not going to get screwed by a sudden bounce in your market or asset. Next up, my strategy is different whether I'm talking about an individual stock or whether I'm talking about an ETF. If we're talking about an individual stock, I'll look at its price action in the past on a chart to determine where it might find support. And these levels of support could be significantly more than just the sell-off that the S&P 500 is seeing. For example, the S&P 500 has sold off nearly 14% in 2022, but the NASDAQ, which is filled with high-growth stocks, has sold off more than 20%, and some of them, like Netflix, have sold off more than 70%. So it's a case-by-case basis when you're talking about an individual stock. When you're seeing a big sell-off, it can be easier to buy ETFs that track the index instead of buying individual stocks. And two of the ETFs that I use in my own retirement accounts are VOO, which tracks the S&P 500, and VTI, which tracks the total US stock market. By buying into these ETFs, you can buy in at 13% down, and sure, the S&P might sell off more than 20 or even 30%, where you could add more at those levels. But the question you have to ask yourself is the S&P 500 going to be higher than where I'm buying in 20 years? If you believe that the S&P 500 will be higher than wherever you're buying in 20 years, then now's a good price, even if it does see a 20 or 30% discount. There's an adage I love when it comes to the stock market. The stock market is the only place where everything goes on sale and buyers run from the store instead of running into the store. And it's just human nature. We see the stock market sell off and we want to protect the assets that we have. But if you're talking about your retirement, you're talking about assets that you're not going to need or use in more than 20 years. What are you going to do if you liquidate that fund? For me, I'm not independently wealthy. I need my retirement savings to grow from now until when I'm able to retire. If I go to cash with all my retirement accounts right now, I won't be able to retire. There's not enough money in there to make it so that I can pay for my retirement. And since I have no way of definitively knowing how much lower the stock market could go, it makes much more sense for me to just keep adding to my positions instead of taking all that money out when I don't know how low we could go. I could very easily get out at the bottom. That brings me to another key strategy I do. I always buy in stages and I never buy all at once. There's no value in me saying this is as low as it's going to go and then me putting all of my money in at that point, because it could sell off much lower. I start adding to my positions when you see a 5 or 10% sell off, but I don't add so much that I never have cash on the sidelines. Additionally, that brings up another good point. You should always have some cash on the sidelines. Now, how much you have is totally up to you, but for me, as we were going into 2022, I had more than 30% of my entire portfolio in cash at that time. In fact, thanks to the S&P 500 selling off as much as it has, although I've put in more than 10% of that cash that I had on the sidelines, I still have more than 30% of my positions in cash because the overall portfolio dropped. Again, this is a really personal decision. A lot of professional advisors will tell you that you should never have more than 10% of your portfolio in cash. However, this is the way that I've done it for 25 years and it's always worked for me. However, it also means that I'm going to start putting that cash to work much sooner than a lot of people would, and I'll be buying all the way down. During the pandemic sell-off, I was putting in tons of money all the way down and it felt like I was lighting it on fire. However, thanks to the huge run we've seen since March of 2020, there was no buy that I did in the pandemic sell-off that did not pay off in the long run. Market sell-offs are going to happen. If you have 20 years or more until you retire, I'm going to ruin something for you. You are going to see an epic market sell-off, and I mean something that's more than 20%. In fact, in the last 25 years, I've seen epic market sell-offs a lot more than just a few times, with just the pandemic sell-off being 35%. But during the great financial crisis, that sell-off was more than 50%. So is there one coming? No one knows for sure. There's no way of predicting all the different variables that could go into a market sell-off, but it's important that you plan in advance and know what might happen. To learn more, check out my website, getirk.com, which is always 100% free. Please hit like and subscribe, and I'll see you in the next video. Hi. What can I do for you? Yes, hello. Do you like stock market crashes?
I like it when I can bite my milk bones on cheap. I like cheap milk bones. I do. I like it when I can buy my milk bones on cheap, so I like market crashes.
We're talking about stock market crashes, though.
Well, I don't know what you're talking about. I want kisses. Kisses.